Friday, March 30th, 2018, Monaco 64, home of alternative economics and contrarian views. Most of the markets are closed today for Good Friday and Passover. Cryptocurrencies, of course, never stop trading. So there's not much aside from cryptocurrencies to report about in terms of market action this morning. So actually, I want to talk about markets. My background, of course, is in banking, broking, financial markets. So I want to tell people a few stories and the fact that markets are not that complicated. I think the terminology people in the markets use sometimes are unknown to the people on the street or people who are not in markets, and that's why it makes it seem like it's really complicated in rocket science. But before I start, though, just to say cryptocurrencies have rebounded a bit this morning. Bitcoin is 7,200. It got down to a low of 6,600. Ethereum got down to 363 and is now 407. EOS is at 606. That's kind of outperformed of late, which is interesting. LITECOIN got down to 109 and it's now 125. So has this been the capitulation low for cryptocurrencies? Difficult to say. A few months ago, when we topped in cryptocurrencies and we had a big correction, the beginning of the correction, I said, after such a huge move that, when we went from 5,000 to like almost 20,000 in a matter of weeks or months, I said the correction is going to be more painful and is going to last longer than most people think. It's a bit like the Dow recently. It topped in January 26, and it still hasn't gone back up. But I think that one will take a lot longer. So markets, well, the word markets as well. Most people think of markets as the stock market, financial markets, but markets originated, I guess, in antiquity, where people got together to exchange goods. That's a market. They exchanged it. Sometimes they bartered, and then eventually they found that some commodities were always wanted, so they were able to indirectly exchange with something called money. So even today, when you go to the supermarket or to a shop, you're going to a market, and you're looking at the goods, you're looking at the price. If you think the price is too high, you walk out of the shop and maybe try another shop. If you think the price is right, you buy that and you exchange, you settle the transaction right there. And that's all financial markets are. I started out, of course, back in the late 80s, around 1989. And I worked for a small private bank, or in French they call it fiduciaire, a fiduciary firm in Geneva, Switzerland. And I started from the bottom, being not the bottom, but from the back office, so to speak, from settlements, because every trade and transaction in markets have to be settled. When you go to the shop or you go shopping or to put gas in your car, or petrol like they say in the UK, you have to settle that. You have to go and pay for it, or you use your card. A trade always has to be settled. So that's how I learned about all the different, how can I say, asset classes as well, because we had foreign exchange trades to settle. We had stocks to settle, bonds, a warrant, which are kind of like an option. We had options to settle, futures to settle. And all these different trades have, let's say if you trade spot in the foreign exchange market, it's usually, it settles in 2 days. So you do the trade on the 1st of April, it will settle on the 3rd. But someone might want to say, one of your clients might say, I want to settle 1 week forward. So you need to get a different price. So there's all these different things. But They're all quite simple, actually, if you look at them, you know, in a common sense way. So, and what did I do in the settlements or in the back office? Well, we used to get the tickets from the people who used to execute the trades. They used to write down the trade that they did and who they did it with. That's very important as well. Which counterparty, you know, which broker or which bank they used, and and then you'd have to make sure that you got the settlement. How can I say that the counterparty confirmed the trade with you, and that the money exchanged hands, that we paid them the money and we received the asset, whatever asset it was, in our account. So that's how it worked. And then I progressed to the front office, where I would put the trades in myself. And the markets are interesting because there are exchanges, of course, where you call a broker that has access to that exchange. And there are also OTC markets, over-the-counter markets, which are markets that are basically interbank markets. Like for an exchange, you call a bank and you ask them for a price in sterling or cable, and they give you a price. And usually you don't have to tell them if you're gonna buy or sell, but they can tell sometimes. So they give you the bid, where they're willing to buy from you, and the offer, where they're willing to sell from you. So they might say, you call the trader at a bank, and you want to sell $1 million pounds versus dollar, and they'll say, oh, I'm 140.20 bid at 140.20, 140.30. So you say, okay, I'll sell $1 million at 140.20. So you're gonna have to send £1 million to them, and you're gonna get $402,000. So that's how it works. And then you settle the trade. This is an interbank trade. You call the trader at a bank that you need to have an account with that bank as well, of course, so that the trade can go through. A lot of times you can also have what you call give ups, but that's more on an exchange. You can call a broker that you have an execution how can I say relationship with, and you ask them, where is the December gold future on COMEX? And they'll tell you, well, it's so and so, and you say, okay, I'll sell 10 lots. And you tell them, please give up to Goldman Sachs. Let's use Goldman Sachs. I know I criticize them, but let's just say I have an account with Goldman Sachs, and I've called a broker X and said, well, give it up to my account at Goldman Sachs, and they'll do that. Or a lot of times you could call Goldman Sachs and say, where is the gold future? And you buy it, and you say, and you don't have to tell them to send it anywhere, because you can execute and clear the trade with them. So these give up trades are usually when you have trading on an exchange and you have different relationships with different brokers. And why would you want to do that? Well, because some brokers, for example, you might have an account, and what I'm talking about is more for institutional big clients. They can negotiate these things, and that's the people I used to work with. I didn't work with private clients, but I'll keep going. So you could open an account with Goldman Sachs, and they say, we'll charge you $1 for execution and $1 for clearing. And then you go to another broker, you go to BGC, and they'll say, oh, we'll only charge you 25 cents for executing. We can't really do the clearing. We're not clearing members of that exchange. Sometimes the brokers are not clearing members, so but they can execute. So you can do the trade with BGC or another broker for 25 cents execution, and then you say, give it up to my Goldman account, and you give them the account number, and they give it up. And then your back office and their back office and Goldman's back office, all the three are supposed to settle that. So instead of paying $2 to Goldman for execution, $1, and clearing $1, you're going to pay $1 to Goldman and 25 to the other broker. So you're saving 75 cents. And that's why there are such accounts. For the bond markets as well, I know I talk a lot about bond markets. Bond markets are, I would say, the bulk of it, if not the whole of it, is traded, excuse me, over the counter. So you have to call a bank, a broker who deals in bonds, a market maker. I'm not sure there's too many bonds trading on the New York Stock Exchange. It's mostly done on the phone. So you need to, a lot of times now on the screen, and you call them and say, can you give me a price for 10 million General Electric 2025, 5%. That's the other thing about markets. You need to make sure you get the right security, because there are, GE could have several bonds that mature in 2025. So you need to make sure you have the right coupon. Usually they have like a identification number. So that's the best thing, to make sure that that's the number. And the other thing that sounds really silly, but you got to make sure you do it the right way around. Like you sell it instead of buying, and also prices when you're on the phone. If you're doing a trade on the phone, if you want to sell 50, let's say lots of futures, you got to make sure you say 50, because at 50 and 15 sounds similar on the phone. If you're going to sell 15, make sure you say 15, or else they might sell 50 and you only want to sell 15. Yeah, and there's all other terminologies in the markets, especially the bond markets, cash bond markets, which I started in as well. If they quoted you a price like a bid and offer on a long bond, for example, and there's a terminology to say I'll lift the offer, and lifting the offer means you're buying. So if there's 20 million long bonds offered at a price, you say, and you want to buy 20, you just say lift the offer. The guy on the other side, or the girl on the other side, is going to say, okay, you bought 20. You paid. Actually, the other thing as well is you paid. And then if you want to sell it, you said, hit the bid. I'll hit the bid. And they'd say you sold at. That's the other thing as well. Whenever you said at, it means that you sold. If someone was confirming to you, they would say you sold 20 million long bonds at. But if you said you sold 20 million long bonds for, it would confuse you, because for is when you're buying. So you paid for 20 long bonds. So that's the other thing. There's all these terminologies so that you could, it's a busy market. I remember when I started out, through the non-farm numbers, a few minutes before 1:30 London time, the whole dealing room was dead quiet. And then all of a sudden, after the number came out, it was like mayhem. And these expressions were good because it kept things simple, and it had to be quick. And we're talking millions. You don't want to make a mistake. Well, that's the other thing I want to talk about now as well: errors or mistake. And when I worked as a futures broker, the futures market was still, there was an exchange, physical exchange, like you see the photos. Those are gone. But I always worked up in the office, because some clients like to talk to the brokers in the office instead of going directly to the brokers on the floor. And on the floor, there's there's the brokers that are in the booths. And the booths are owned by the brokerage houses and the banks, and they get a call from a client directly, let's say, and they say, I want to sell 100 10-year note futures. The guy in the booth will signal the order to the guy in the pit, and then they'll get the confirmation. They'll tell the client. Some clients, they wanted to talk to us up in the office, because they wanted to talk about the market, what's going on. They just didn't want to execute quickly, so they talked to us, and we had a direct line to our guys in the booth, and we give him the order. And I remember when I started out at GNI in London, we were on the same building as the Life Exchange, and the dealing room was quite big. And we had 3 guys. They were the link. They used to call. Their job was just to call, let's say, the Bund booth directly and take orders from all the brokers in the dealing room. And the Bund future was the busiest. That was the German government bond future on the Life Exchange. And we actually learned the hand signals that were used down on the exchange in the dealing room, because when it got really busy and you had dozens of people trying to tell the guy in the link to do something, you just gave him the signal. And for the Bund, for example, it was this, which you can probably guess why, the German government bond future. You say this, and let's say you wanted to sell, let's say 100 contracts. You went like that, so your hand away, that's 100, and you went, and then you gave him the price. Let's say you want to sell at market, you just went like that, 100 at market. So if you wanted to buy, you went like this, or you could just look at the Bund link guy. You didn't have to make the signal. You just looked at him and said, market, that's buying, because it's not away, it's towards you. You went cross like market for 100. Or if you wanted to pay, if the market was par 21, bid at 22, and you wanted to pay 22, you say 2 for 50. That's 50. And one lot is just here, 2, 3, 4, 5, and then 6 went like this, 7, 8, 9, and then 10 is 1 up here. So it's all the hand signals. And if you wanted to know a spread between different months, you looked at the Bund guy and you went like this. What's the spread between March and June? It was very interesting. And of course, yeah, there were errors. I remember, and everyone made errors. And you always hope that you found out right away that you made an error and that you rectified it, because it could mount up to a big loss or a big win. But even if you had an error and then you found out about it like 2 hours later and you made, let's say, $50,000, you had to write an error report and have a meeting, with your boss, your manager, and he'd say, you have to be careful, what happened. You try to work out and say, next time try to do this, even if you made 50,000, because it could have lost 50,000. And I remember once in 1994, which was the big year for a bond bear market, we had this figure that was really important that used to come out of Germany, the German M3 that the Bundesbank used to publish. And the German central bankers were always very worried about inflation, and they wanted to keep M3 within 4% growth a year. And one time it came out at 30%. And you can imagine how the dealing room went crazy. And I was trading loads of Bunds, German government bonds. And then at the end of the day, we realized that I had bought an extra 50 for one of our clients. Luckily, we made money on it. But and how do you find out you've made an error? Well, when it's busy like this and everyone is giving orders, and you've got 2 clients on different lines trying to do things, and you put an order and you don't think the guy in the link got the order, and you put it in again. And then the only time you have to check it is when things calm down, and then you realize, oh no, I bought 50 extra. So yeah, and a lot of times instead of selling, you bought, so that's how the markets work. And then eventually by the late 90s though, all the live floor closed down and things were done on the screen. So some of the brokers on the floor, they came up to the dealing room. A lot of them went their way and they started trading for themselves. I remember there were a lot of offices popping up where you could rent a space and you have the screen and trade on the screen. I actually was able to stay till 2012, still talking to my clients in the office and doing the futures and the options. So even though the exchange business closed down like in 1998, I would say, I was able to eke out another 14 years in the futures market. And that's how the markets work. Of course, there's different asset classes. You've got the simplest asset class, of course, is cash. And it depends what country you're in. You've got, let's say you're in the UK, you hold a sterling balance. You can hold a dollar balance as well, or euro. At the time there was Deutschmarks, French francs. And the reason you have the balances is that you can use that cash balance to buy securities, to buy stocks, bonds, futures, or derivatives in other currencies. And you have to make sure that once you close the positions, if you made a profit and you want to turn it into a different currency. So that's how it works. And you've got the commodities. The futures exchanges provide leverage as well. That's what you got to look into when you do futures. A lot of times when you buy 100,000 worth of bonds, let's say dollars, you're actually only putting, $5,000 to $7,000 down. So you got to make sure you how can I say, manage your risk. So that's what markets are. And from my years in the market, and the most important thing is that if you don't want to lose money, first of all, you got to know what you're going to trade. You got to know which way you're going to go, buy or sell, how many and what price, and you got to confirm the trade when you're putting the trade to get executed with the other counterparty. Nowadays, it's the screen. You got to make sure you put the right order in, the right price, and that's what it is. The markets, and it's just like any other market out there. Yes, it's gotten a bit out of hand. It's a bit of a casino, but I thought people might be interested in knowing how it used to work. A lot of people ask me about how the markets work, and I would say though that for people who their profession or their job is not in markets, if they want to get involved in markets, it is a full-time thing if you want to be successful. So that's why you need to take it. The reason why I know all these things is because it was my job. It's not like I was, doing something else and did this on the side. It's a business, it's a 24-hour thing. That's why I always warn people if they want to get involved and it's not their profession that you need to be very careful. So that's it. If you enjoyed this video, please like, share it, subscribe to my channel if you haven't yet, and you can also follow me on Twitter and on steemit.com. Steemit.com, of course, is linked to DTube, which is kind of like an alternative for YouTube as well. So I'll talk to you later. Have a good Easter weekend. Take care.